Today on GrowthShares, we're going to rank which oil and gas company is a better long-term investment right now. We're going to rank these companies based on earnings growth, the PE ratio, dividend yield, return on equity, free cash flow, and the stock's intrinsic values. Each are weighted based on importance. Each metric will be given a grade from 0 to 99, with 99 being the top end of the scale. After that, we put everything together to get our overall ranking. I encourage you to pause this video at any time. Growth is the backbone of my analysis, and you want a company that continually grows. A growth rate of 3% is average, as it equals the long-term inflation rate. A rate of 8% or higher is what I consider a good growth rate. Here's the growth rate rankings along with the corresponding grades. We'll keep that number in mind because we'll need it when determining the intrinsic values later on. The PE ratio is a popular valuation metric that tells us at what multiple the stock is trading at compared to its earnings. A PE ratio at 25 is average, and anything at 15 or lower is what I considered a good PE ratio. Here's the PE rankings along with their corresponding grades. The more of a premium the stock is trading relative to its earnings, we can assume it's more overvalued. It's not a bad thing, but it's an important part of my valuation. Dividends are an underappreciated metric when analyzing a company. Taken in a vacuum, the higher the dividend, the better. A yield of 1.5% is average, which is in line with that of an index fund. A yield of 2.1% or higher is what I consider a good dividend yield. Here's the dividend yield rankings along with their corresponding grades. If you own a stock that doesn't pay a dividend, you're not making any money from it. The only way you can make money is if you sell the stock. And if you're a long-term investor, you don't plan on ever selling. So that means you need a dividend to pay while you hold. Return on equity is profit generated with the money shareholders have invested. Basically, how much you're getting back for every dollar put in. A 6.75% return on equity is average, and anything at 11.75% or higher is what I consider a good return on equity. Here's the ROE rankings along with their corresponding grades. A company's ROE measures its effectiveness in handling the money you invest when buying its stock. You want something good in return. Free cash flow is what is left after a business pays its day-to-day operating expenses. We always want positive cash flow for our company, which means more money coming in than what's going out. A free cash flow of $12.75 billion on its balance sheet is considered average. A free cash flow of $17.75 billion or more is what I consider good. Here's the free cash flow rankings along with their corresponding grades. I look at free cash flow as a measure of our company's market dominance. Cash is king when it comes to research and development and acquisitions. It's a big part of what gives a company its economic moat. The way I calculate intrinsic value is by using a discounted cash flow model. Intrinsic value relative to its stock price of 0% means the company is fairly valued. An intrinsic value of 17% or better is what I consider an undervalued company. Here's the intrinsic value rankings along with their corresponding grades. Before we get our overall ranking, consider becoming a GrowthShares Patreon member. You'll get access to every grade from every company I've analyzed. It's updated all the time. Head to patreon.com/GrowthShares or click on the link in the description. A grade of 50 is average, and a final grade of 70 or better is a good long-term investment. Here are the overall grades and their rankings. This analysis is simple, yet an effective way to get your research started in the right direction. There are a lot of numbers out there and a lot of noise. Keep your investing simple and you'll do fine over the long term. So what kind of investor are you? Let me know. Take my free survey. I left a link in the description below. Once I get enough data, I'll make a video about what I find. Link below. Don't forget to subscribe if you like this analysis and want more in the future. Invest wisely, and as always, take care of your money.